Hi there, welcome in today. And in today's video, I'm going to discuss this pattern that's currently in the charts, what Bitcoiners are saying about the upcoming halving, and whether or not this Bitcoin rally is over and if we should be cautious or still buying. And if you're interested in any of that, then you should definitely stick around. Hello, welcome back. My name is Josh, and this is the Crypto Biz Show. Thank you for stopping by. And we're going to be going over this article here talking about the Bitcoin rally and whether or not it is over and reasons we should be staying bullish on Bitcoin and cryptocurrencies overall, especially with the halving just around the corner. All right, so I'm going to read this article and we can go over and discuss things afterwards. So it says Bitcoin has pulled back more than 15% since hitting an all-time high 1 month ago, with some major altcoins nosediving 40% to 50%. But few understand how normal corrections like these are in bull markets, one observer noted. And here's some bullet points. Crypto correction has clobbered investor sentiment, but there are still plenty of reasons to stay bullish on digital assets, analysts say. Leverage wipeout made the market much healthier. Bitcoin halving may have positive impact on price, with spot ETFs reaching a wider audience. An Max Group strategist noted, stock market weakness could weigh on crypto assets, but drop would be short-lived with other narratives at play, microanalyst Noel Action said. Okay, so to go over the first bullet point here, crypto markets took a sizable gut punch over the weekend, sending investors' sentiment to the basement from euphoric highs only a few weeks ago. Bitcoin tumbled below 62,000 on Tuesday, lower by more than 15% from its latest record price above 73,000, while altcoin darlings Solana, Pepe, and Dog with Hat suffered 40 to 50% setbacks from recent highs. Despite the sizable drawdown across the board, there are still a handful of reasons to be bullish on digital assets, even if prices cool off further or chop sideways for a while. The Bitcoin halving effect. So, Bitcoin will undergo its fourth halving later this week, a recurring event in roughly every 4 years when the newly issued supply of tokens, the rewards for miners, will be cut in half. Historically, Bitcoin's price didn't move much around the time of halving, but the event preceded parabolic rallies. As far as the halving event goes, we've been in the camp where we don't expect there to be much additional upside momentum, said Joel Kruger, a market strategist at LMAX Group, adding that this is a known event that has been well telegraphed by the market. However, with spot exchange-traded funds listed in the U.S. from traditional finance giants like BlackRock and Fidelity starting ramping up their sales machines to financial advisors and wealth managers introducing Bitcoin to a broader investor base, this halving might bring some tailwinds for Bitcoin's price. At the same time, we do believe that there is some room for a rally when considering this is the first Bitcoin halving that will be playing out in front of a much wider audience, now that the Bitcoin spot ETFs are up and running, Kruger pointed out. The halving event could therefore get these investors more excited about Bitcoin as they are forced to take a deeper dive, which could then translate the desire to take on even more exposure, he added. Eric Balchunas, senior ETF analyst at Bloomberg Intelligence, last week noted BlackRock advertising its Bitcoin fund IBIT on financial news outlet Bloomberg's homepage. Now, moving on to the next section of the article, defying macro turbulence. While momentum on crypto markets faltered over the past weeks, the catalyst that eventually kickstarted to correction last Friday stemmed from macro events. Traditional markets turned jittery on increasing fears of military escalation between Israel and Iran, while bond yields and the U.S. dollar rose sharply as investors priced out rate cut expansions amid strong U.S. economic data and rising concerns of sticky inflation. Noel Atkinson, macro analyst and author of the Crypto is Macro Now newsletter, pointed out that the earnings yield on the S&P 500 is now below that of both 3-month and the 10-year U.S. Treasuries, which could foreshadow further downside for U.S. equities. The relation should be the other way, to compensate investors for the higher risk in owning stocks rather than bonds, she explained. If the stock market drops sharply, Bitcoin and other crypto assets could get temporarily hit as well, Atkinson said. However, the crypto drop would be short-lived, though, as other ongoing narratives, store value, halving, currency hedge, new use cases, and growing adoption will encourage accumulation at lower levels, she added. Atchison said that there might be some potential good news on the short term that would offer relief from rising yields that squeezed risk assets recently, although it's not very likely. The Federal Reserve could revert to insisting that rate cuts are imminent, which should temper the rise in yields, she said. I'm not expecting this, but if it happens, risk assets should do well. And on to the next section, that covers the leverage wipeout. Massive liquidation events on derivatives markets often mark the bottom for asset prices, wiping out excessive leverage and cleansing the market from exuberance. Crypto markets endured one of their most brutal leverage flush, liquidating over $1.5 billion of bullish bets on Friday and Saturday combined. And here you can see on CoinGlass, there is a chart showing these green candles here indicate more money being lost on the betting on the price to go upside, and the red betting on the price to go downside. And as you can see, the green candles are a lot larger than the red candles. So there's a lot more money that was lost because the price went down versus when it went up. And leverage is basically borrowing money to take on a position size that you normally wouldn't be able to do with just the money that you have regularly. Okay, and so moving on to the next part of this article, the market is now much healthier. Vetley Lunde, a senior market analyst at K33 Research, said both open interest and funding rates have been drastically reduced, reducing the likelihood of liquidation cascades onwards. This, accompanied by Bitcoin holding firm above 60,000, is a robust signal, Lund added. The events are reminiscent of last August's action when Bitcoin plunged from 28,000 to near 24,000, with liquidations nearing $1 billion across all digital assets, following the largest daily drawdown since the FTX crash. Prices hovered in a range for almost 2 very dull months until October's breakout above 30,000 to much higher prices. Now, moving on to this part where we talk the typical bull market pullback. Okay, so with Bitcoin pulling back 16% from its recent all-time high in March, the current drawdown is in line with typical drawdowns of previous bull markets. The 2016, 2017, and 2020-2021 bull cycles all had multiple 20 to 30% pullbacks before continuing to much higher prices. Few understand how normal corrections like these are in bull markets, crypto analyst On-Chain College said in an X post. And here we have a tweet by Glassnode. Says, if we compare the Bitcoin all-time high break in prior cycles, it could be argued that current euphoria phase, market and price discovery, is still relatively young. Previous euphoria phases have seen numerous price drawdowns exceeding minus 10%, with the majority being much deeper with 25% or more. And here is just a chart showing what happens once we break, what has happened in the past, at least in 2017, 2018, and 2021, and 2022, what price action has done following the halving. And as you can see, we break the all-time high here in 2017 at roughly, I believe that is 1,300. And then it went on for the next 12 months to reach about 20,000. And in 2021, we were actually, I believe, the all-time high break was in December, and then from there we went on to go up to 69,000 the following year. But we usually see once the all-time high breaks, there is a 12-month rally that continues on, and Bitcoin usually reaches some sort of top, I guess, in that location. And it says, despite the current nervousness, hedge fund QCP Capital said Tuesday that it continued to see consistent, sizable demand for Bitcoin and ETH calls for longer-term expiries out to March 2025, signaling that market participants still expect higher prices coming. And that is the end of that article in all those sections. Now let's go over and kind of discuss what is being said. So coming back here to do some little bit of summary of the article here, we talk about the Bitcoin halving effect, and Joel Kruger said that as the halving event goes, we've been in the camp where we don't expect there to be much additional upside momentum, and I think that is fair because we have run up quicker than expected. But I mean, did we really run up quicker than expected? I mean, the largest asset manager on the planet is coming into crypto now, and they offered an ETF. And guess what? Their clients are very wealthy, and they have lots of influence and control over markets and our daily lives just in general. So, I mean, I kind of feel like this is very expected, especially BlackRock and Fidelity, two of the largest, asset holders on the planet, now introducing Bitcoin products to their investors and clients. Not shocking. Let's see here. It says that at the same time, we do believe there's some room for rally when it considers the first Bitcoin halving that will be playing out in front of a much wider audience. Yes, there's some room. I think we could see $100,000 or more relatively quick, just because it just kind of depends on where BlackRock and Fidelity in these larger institutions, how much advertising and how much marketing that they want to put behind, getting Bitcoin out to the masses. And also, the halving is a selling point for people who have been in crypto, but for people who aren't in crypto, they have no idea about the halving, and nor do they really care because they don't really understand it. Most people who aren't in crypto are just going to see the price, right? And you're going to tell them all you can really say and be like, oh, yeah, there's this thing called the halving where the amount of Bitcoin that's given out every 10 minutes to miners who secure the network, it's just cut in half. Like, oh, okay, that's cool. But other than that, I wonder how BlackRock and Fidelity are going to market this, and how much they're going to do it. Okay, well, moving on to defying the macro turbulence. Going over here, they say the S&P 500 is now below that of both 3-month and 10-year U.S. Treasuries, which could foreshadow further downside for U.S. equities. Relationship should be the other way. I agree. But they're saying if the stock market drops sharply, Bitcoin in the crypto sector is also going to be hit, right? And I do think that we are still correlated to traditional finance, especially now since BlackRock and Fidelity are in here. So you're seeing a lot of traditional finance money who is either already been in the space or is coming into the space. But they're going to probably pull their money from crypto quicker than they will out of their traditional stocks, right? And most of the liquidity and money is in traditional finance. So when someone goes and makes a big sell order in crypto, especially Bitcoin, the price is affected a lot more than say in TradFi, right? Because banks work with TradFi and S&P 500, whereas here in crypto, we don't have no banks, right? There's people who take money out of their banks or their IRAs or 401ks and put it into crypto, but there is no banks in crypto. You can't go and get, say, a loan against your crypto assets from a bank like you can with traditional finance, and that kind of helps with adds a little bit more liquidity there that we don't have in crypto. But those products are being built in crypto, to be fair, but it's just not more widespread. And I feel like DeFi is going to take a while for more people to experiment and play around with. And I think people still have to be onboarded onto that because there's still people out there who don't have Bitcoin wallets and don't really understand how to make one or how to use one. And I think as a boomer, you're not going to want to do that. But, okay, moving on to the leverage wipeout. Massive liquidation events on derivatives markets often mark the bottom for asset prices, wiping out the excessive leverage and cleansing the market from exuberance. Yeah, I mean, flushing out of leverage is always a good thing, in my opinion, because you want like real holders to be in the space, right? Obviously, in crypto, there are a lot of traders, and that's why we do have volatility. And the less trading, the less volatility. But, if we just want the price to continue to go up, you don't want people selling. You just want people buying, right? And you want people buying and holding, not doing short-term trading, which is what all this leverage stuff is. I mean, people just trying to make a quick buck in a short amount of time. And this is why a lot of them get punished and get flushed out by other traders who take the other side of that trade and bet against them. And it's just one guy thinks the price is going up and the other guy thinks it's going down. And then one of them has to be right? And so whoever's right takes the other person's money. So, I mean, if you're going to be doing that stuff, I would definitely want to have enough money to basically control and manipulate the price. Because then I can up my chances of being correct when I can, have a higher chance of deciding where that price goes because I have a large amount of capital or, coins at my hands. But going back to 2021, we saw there was a lot of leverage in the market, and a lot of experts out there in the world said that Bitcoin's market was suppressed. So instead of going to 69,000, we probably should have seen, at least six figures. But because of leverage and people, especially Michael Saylor, was one of the guys who took out leverage and to buy more Bitcoin. And we had Do Kwon, who was using leverage and buying Bitcoin. I mean, a lot of that stuff had to be flushed out. And that kind of is probably the reason why we weren't able to see higher prices than we were expecting. And we got this kind of like double top pattern, because we went to 65 and then we went to I think we went to 67 and then we went to 69. There's not much difference in the price there. But instead of going to 67 to 69, you would have expected the price to go from 67 to 115 or 130 or something like that. But we couldn't even get that. So a lot of people were kind of questioning and trying to figure out what the heck happened. But, we're here now. And I think in this cycle it has been a lot healthier, but I do believe there will be some bad actors that come along and, somehow come onto the scene and everyone's going to be talking about them, promoting them. And then they're, going to take everybody's coins like they always do. And then here we have typical market pullbacks. Let's go over this again. So with Bitcoin pulling back 16% from its recent all-time high in March, current drawdown is in line with typical drawdowns of previous bull markets. And it talks about other pullbacks that we've had in the past. And yes, so, right. This cycle currently that this run we've kind of been on, we haven't seen a lot of pullbacks, right? And I think that kind of has to do more with just the type of investors and buyers that are in this market now. I think there aren't as many short-term traders as we've had in the past. So more people are just buying and holding on to their coins instead of, trying to buy and then sell, the next week or the next day or even hourly. So which is healthy because then you can get more price going up, right? Because if people are buying and then they're selling, the price is going up and then it's going down and up and then down and up and then down. But I mean, that's going to be natural. Markets are always going to do that, right? You're always going to have buyers and sellers. You need them because if nobody sells BlackRock and Fidelity Bitcoins, where are they going to get them, right? And so we're just kind of stuck. So we do need, right, you need a right supply and demand balancing each other out. But obviously with the halving, we're going to see the supply cut in half. Now, I don't know what the demand is going to look like, but apparently we just got a Hong Kong ETF, Bitcoin and Ethereum ETF approved. But it's going to take that about, I think, a week or two for that to be settled and actually start taking in investor money. So I think we could see some sideways action till then, or we could just start melting upwards, in 2-3 days from now. Who knows? But that just kind of summarizes what I took from the article and just kind of gave some of my opinions on that. Do with that what you will. And I also wanted to come here to the charts, kind of just talk about what we've seen post halving from at least the past two. From the last halving, so this halving in 2016, price increase went up about, I'd say about a 30x, right? It was 2,900%, but give or take like, 3,000%. So that was about a 30x. And that took about, that took 524 days. So that rally lasted 524 days. Cool. Now let's go on to the next one. Oh my God. Okay, here we go. Here we have, and this is like the double pattern or the double top thing I was talking about. He had one top and he had a two. And in like trading terms, they call that a double top, I guess. But measuring the halving price to the top, we'll call the top here about a 700%, and that took about 550 days. So we did see in the short term, basically the fast run up here that lasted about 338 days. Let's see, did we get that here? I mean, this one was longer. We did see like a huge dump here. Okay, well, my thing just reset for some reason. This one was not as fast, and we did see a dump, like a 27% dump here. But like they were saying, these kind of pullbacks are natural, right? Not natural, but these are more frequent than they in the past. Like that was 35%. This is 35%. I mean, let's see. Wow, yeah. I mean, a lot of 35% corrections. See here at the bottom, this is about 40%. I mean, anywhere from 30 to 40% is normal, right? Yeah, that's 30%. And what was this one? This one was a little bit more than normal for that time frame. I guess that kind of would have been a signal that that was the end. But as you can see here, this rally lasted, and this was a lot longer, and there was a lot more corrections. So, I mean, hopefully we do see this type of rally. But if we do see this type of rally, I do expect a lot of, 30 to 40% corrections along the way. And this was 526 days. Okay, nice. But this one was it went very parabolic and very quickly, right? I mean, I guess most of these charts did. But this kind of went flat. We didn't really see corrections like that. We did see here 17%, 7%, and 17%, 9%. Okay, I'd say this is a major correction. Okay, so this was like the first 30% we saw, and that was after we ran from like basically at the halving, we were at like 9,000, and we peaked at like 42,000. So we did a 4x before we saw a 30% correction. And then obviously up top here, we did have 25% corrections, and then 18%, and then you had this absolute madness collapse of like 50% or more. I mean, it was higher because we actually came down from 65,000. But and then we did that, but we did recover from that. Right, we came up, made about 135% correction, and then down to find a bottom like 15%. So this was fun, but the 50% corrections were kind of very scary, and we haven't seen that yet. Luckily, hopefully, we don't have to see that anytime soon. And some people are afraid right now, and saying that we might see that here that we have going on right now, but I'm not entirely sure about that. But I do have this triangle drawn up here, and it looks like we're kind of right at the bottom of it. And we haven't broken down or closed a daily candle below this thing. So very interesting on what's kind of going to play out here. Because we could just come right back up here, or, we could just break down from here. And if we were to see, just for example, if we were to see, let's just say 25%, we could see like mid $55,000 dollar price range. But maybe we go down here. Maybe we see a 30%, and we're here at 51.6. Now, I believe this will be better if we did come down to 51.6, because then we have a chance to wash out more of any bad actors and non-holders and leverage traders. But we could also wash out them by going to the upside too, right? Because people who are selling here in this area, who are panicking, thinking we're going to go lower, you go up, they buy. I mean, you come back down a little bit, they sell, then you go up again. But in the meantime, also people who are betting on the price, who are buying or selling or shorting here, betting on the price to go down. If we go up, they become liquidated, and then you pull back, and then they start shorting here. You pull up, they become even more liquidated, and that's just fuel to keep going higher. But yeah, that's that. We don't know which way we're gonna go though here. I mean, but it looks like we're just gonna kind of go sideways here. I don't believe we're just gonna. Yeah, probably. I mean, it looks like we're gonna go down here because currently we are down, and we're not able to recover quickly from this. And you can see this little moving average indicator. It goes from green to red. Usually when it's green, that means we're just kind of positive bullish momentum and we're continuing higher. But it has flipped red. And so looks like we are going to be coming down further. But also you see here, this oscillator is now pointed downwards. And the momentum, the bears have control, or the sellers are in control right now of the market. Obviously, I mean, the prices crashed from 73,000 to 64,000. Like, who's in control? Sellers. Otherwise, why in the heck are we going down, right? Where's the buyers? But to be fair, we are still at 60,000, which is like, or 64,000, which is like, if someone told me we were going to be hanging out at 64,000 for like 3 months, I'd be like, yeah, right. That's not going to happen. But here we are, it's happening. So this, if anything, this shows that we have a lot of support here, and there's buyers here. People don't want to see the price go too low, but people are trading in here, and there are people buying and selling. I don't think we're going to go that low. Maybe lowest 52,000. 52 or 50 to 52,000 would be like the lowest, and then we could just absolutely melt upwards from there. Like do like mine spending numbers, $130,000. Maybe a little small pullback to 100,000 and then go to like 200K. I don't know. Who knows? But gonna be interesting. Gonna be sticking around trying to find out and see what's gonna happen. Okay, now cutting that off and moving on to something else. Now moving on to this article, this opinion about what Bitcoiners are saying about the upcoming Bitcoin halving. Is the halving priced in or not? Will it disrupt the Bitcoin mining industry or accelerate adoption? Here's what experts and community members are saying about the fourth and perhaps most anticipated halving. On April 19th, or whenever a Bitcoin miner mines block number 840,000, the amount of Bitcoin entering into circulation will have from about 900 a day to 450. This event, colloquially known as the halving, looms large in the Bitcoin mindshare, or one of those things that makes Bitcoin Bitcoin. Perhaps because it only comes around on leap years so far, Bitcoiners tend to look forward to the halving more than most holidays like Bitcoin Pizza Day or the anniversary of Satoshi Nakamoto publishing the white paper. But it won't be around forever. Once all 21 million Bitcoins are mined, the halving will have served its purpose and cease, likely in 2140. Why did Nakamoto make it this way? No one knows. Just like there's no real insight into why he chose a 21 million cap or January 9th as launch day, there are many, many guesstimates that try to make sense of these seemingly arbitrary elements of Bitcoin's design. because if there's one thing certain about Bitcoin, it's that it tends to split opinions. And so, with an event as anticipated as the halving, there are certainly things to argue over. It is priced in, meaning will the reduction in supply of Bitcoins entering the market cause a rally? Will the reduced revenues drive Bitcoin miners bankrupt? Will this time be any different? CoinDesk turned to the crypto community to get their say. Priced in, next section of this article, Hasib Qureshi, managing partner at Dragonfly Capital. I am a longtime halving nihilist. The halving is what it means for Bitcoin to be deflationary. It's been priced in since the first time someone bought Bitcoin because it has a fixed supply. The timing of the halving has been baked in since Bitcoin was first launched 6 years ago. People drawing charts and rainbows and all this nonsense over an event that has deterministically happened 4 times on an asset that already goes up almost every single year is pseudo-scientific nonsense. But whatever, it's a good story. Austin Campbell, assistant professor at Columbia Business School. As Bitcoin gains more of a foothold in traditional finance, events that were drivers of past cycles like the halving will cease to have as much of an impact, if any. Portfolio allocators think in multi-year and multi-decade terms, and the impact of events like the halving will be muted as this market segment grows. Just like any market growing from new to mainstream sees volatility due to small idiosyncratic events decrease as liquidity and scale increase. Azim Khan, co-founder of Morph. My personal opinion is the halving is likely priced in. We've seen institutional capital inflows for months now since the Bitcoin Spot ETF was approved. And even before that, we were seeing a lot of liquidity enter the market without seeing traditional signs that retail was buying the things, like Coinbase being the #1 app in the App Store. To me, that indicated it was already institutional money coming in. They're not dumb and have likely been buying ahead of this. Larry Fink didn't get to where he is by accident. My personal philosophy is this space has tended to be that when everyone agrees something is going to happen, it generally doesn't. Similar to when we had Elon being a clown on SNL pumping Doge in 2021, and everyone had agreed it was going to $1, it dumped. It did go to 75 cents, to be fair. The investing approach I abide by has always been to dollar cost average. Pick an amount you're willing to lose. Set an auto buy for that amount of whichever assets you've done your research on. Continue to buy over the long term every X period, and never look at the price. If you're investing with a long-term approach in mind, this will help you beat out 99% of the noise you see from gambling addicts, some of which turned out to be the lottery winners of crypto Twitter when zooming out through the years. Okay, and that is the last of the people who think that it's priced in. And then you have people who, on the other half of the argument, say it's not priced in. The first one is Eden Yago, founder of Sovereign. Definitely not priced in. Not even close. This is the most important halving since the first. This halving will bring new assets to Bitcoin in the form of runes. In the coming cycle, we'll see Bitcoin rollups add scalability and programmability to Bitcoin. Bitcoin block space will go from cheap to the scarcest computing resource in the world. Ogle, founder of Glue. I think that this halving is distinct from prior ones because of the significant increase in capital coming into the market because of the ETF approvals. So, you have a reduction of supply because of the halving itself, combined with increased demand from the ETFs. Basic economic principles say this should result in a higher price. My guess is the halving has particularly been priced in, but I don't think people quite realize the magnitude of buy pressure that is coming in via the ETFs, and that the buy pressure is, in my view, going to significantly impact the price of Bitcoin upward. Uncle Rockstar developer, core contributor to Bitcoin Pay. Given the historical data, 9,575% increase post 2012, 3,233% post 2016, and 667% post 2020. It's not a question of if the Bitcoin USD price will rise after this halving, but rather by how much. Feel free to quote me on that. And some people say this time it's different or not. Ed Hindy, Chief Investment Officer at Tyre Capital. Bitcoin remains a viable doomsday asset in 2024, as its correlation to gold recently increased, and investors continue to diversify away from traditional financial assets. The ETF is currently spearheading this doomsday rally, and we should expect 120,000 to be hit in the coming months as global geopolitics continues to deteriorate and the middle classes continue to find ways to protect their wealth. We believe that price action ahead and post-halving is going to be different from past events as there are new variables affecting Bitcoin. The combination of an uncertain geopolitical situation, choppy U.S. spot ETF flows, record leverage, and recalibration of the U.S. Federal Reserve monetary policy is going to create an explosive combo and lead to extremely volatile market conditions. We would not be surprised to see Bitcoin trade as low as 55,000 and as high as 75,000 in the coming couple of weeks. We remain very bullish into year-end, though, and considered 120,000 to be a realistic target. Now, we have Roger Ver, creator of Bitcoin Cash, also known as Bitcoin Jesus. Nothing special happened for the last 3 halvings. I don't expect this time to be different. That was very short. Caden Stadelman, Chief Technology Officer of Komodo Platform. The biggest difference between the 2020 halving and the 2024 halving is skyrocketing institutional demand. Prior to the previous halving, institutions were on the sidelines. The market was dominated by retail investors. Since then, the market dynamic has drastically shifted. As one example, MicroStrategy didn't make its first Bitcoin purchase until August 2020. As of April 2024, the company reportedly holds 214,246 Bitcoin. Of the 21 billion Bitcoins that will ever exist, around 12.27% currently belong to publicly traded and private companies, ETFs, and countries. Adam Bloomberg, co-founder of Interaccess, the halving will have likely an impact on the price, as we have greater demand than ever from ETF investors, Bitcoin hodlers, and even corporations, and we're coupling that with a decreasing new supply. We'll also see an impact on miners who have tremendous capital and electricity outlays, and will get their production cut in half. Now, moving on to the article, they talk about the impact on mining. Colin Harper, researcher and writer for Luxor Technologies Hash Rate Index. This halving could be unprecedented with regards to how it affects Bitcoin's total network hash rate. It's possible that we see no hash rate come offline after the halving, or that we will see the smallest decrease in network hash rate after any other halving event in Bitcoin's history. Mining margins won't be as good after the halving as they are now, obviously, but they won't be horrendous. If the new Rune's fungible token protocol makes a significant impact on transaction fees, then margins will be healthy enough to keep miners with higher costs online for longer than not. For comparison, Bitcoin's hash rate declined 15% after the 2020 halving, 5% after 2016's halving, and 13% after 2012. Joe Downey, Chief Marketing Officer at NiceHash. This halving is different. We will likely see less volatility than previous ones, for a few reasons. One is that Bitcoin mining is far stronger than it has ever been before in terms of hash rate. Another is the level of legitimacy Bitcoin has gotten recently due to institutional funds and ETFs, plus the fact that a lot of people are in wait-and-see mode. This makes for a far more stable basis for Bitcoin to hold its current value and gradually increase over the course of this year. There may be some short-term volatility during the following week or two after the halving, but I expect things to stabilize quickly after that. Troy Cross, professor of philosophy at Reed College. Professor of philosophy at Reed College. There are 2 sides of the halving story: price impact and mining impact. On the price side, I don't have anything to say. The supply shock should be priced in, but every time I have thought that and every time I have been wrong. I won't pretend to read the collective psyche with everyone anticipating that everyone else is irrational and not pricing it in. Who knows what will happen? I tweeted recently about the U.S. government's holdings of Bitcoin. Over 200,000 Bitcoins, and much of it Silk Road seizure. In terms of the impact on supply, that's at least as important as the halving event. And then Troy Cross, in his Twitter post, he says, trigger warning, FUD post. The U.S. government has 215,000 Bitcoin. Germany has 50,000. MicroStrategy has 214,000. And GBTC has 340,000. So the USG has the same stack as MicroStrategy, MSTR. At post-halving issuance rates, the U.S. stack is 1.3 years worth of mining. So how is the halving a big deal? Well, this ... Not going to open that and read that. I'm just continue on with the post. But on the mining side, the halving does get me excited. The halving will force miners to seek out even cheaper power than they already have. Some miners will go under, selling off their equipment to those with more efficient operations. The break-even point for properly running an ASIC will nearly drop in half. Miners will start curtailing more often, particularly their older machines. What happens next depends on Bitcoin's price action. But if prices do not rise dramatically, we will see a dip in hash rate while ASICs find cheaper homes, and then mining will settle into its dung beetle role, consuming only wasted, stranded energy. The differences between a cost-sensitive consumer of energy like Bitcoin and traditional data centers or AI data centers, or really any other electricity consumer, are already clear. But after the halving, Bitcoin's flexibility, shutting down whenever electricity prices rise, and its opportunism, finding pockets of currently stranded energy bottlenecked by transmission constraints, will be even more dramatic. Maria Bustillos, founder of Flaming Hydra, a part of the Brickhouse Co-op. I just hope this finally gets people reckoning the gigantic difference in environmental costs between proof of work and proof of stake chains. Now, effects on adoption. What this means. Peter Todd, founder of Open Timestamps and Bitcoin Core developer, the halving is one of the dumbest parts of how Bitcoin was designed. If you're going to reduce subsidy over time, the right way to do it is gradually. Rather than shocking the system every 4 years, fortunately, fees are getting higher, so the risk of halving is reducing. Hopefully this one goes all right. Fortunately, fees are getting higher, so the risk of halving is reducing. Hopefully this one goes all right. Okay, that was a repeat. Zuko Wilcox, founder of Zcash. I'm interested in the Bitcoin halving because of supply effects. I have come to frankly detest that part of the markets which is independent of fundamentals. You know what I mean. Hype, narrative, people buying when they see something go up and selling when they see something go down. The Keynesian beauty contest, the greater fool theory. Meme coins, meme stocks, pump and dumps, insider trading, misinformation, disinformation, FUD. I was always naturally against such stuff, but my long, painful experience in the crypto world has made me hate it. Bitcoin's and Zcash's asserted supply limits is the very opposite of that, the thing that no amount of hype or misinformation or mass mania can touch. And it's interesting to think about the difference between talking about the supply of Bitcoin and Zcash being 21 million versus talking about it being the ongoing addition to the supply from mining. Alex Thorne, head of research at Galaxy Digital. The Bitcoin halving is the programmatic mechanism that creates and enforces Bitcoin's most famous quality, its scarcity. While this fourth halving reduction in new daily issuance from 900 Bitcoin to 450 Bitcoin is small in absolute terms and relative to Bitcoin's daily float of 10 to 25 billion, nonetheless, prices are set on the margin. But beyond any supply impact, which I believe is marginal, this is the first halving in which major U.S. asset managers are educating on Bitcoin. And there's no better education than learning about the halving. It's a narrative event first, a quadrennial market moment, and a supply event second, though I think both aspects will be impactful. Tatiana Kaufman, general partner at Moonwalker Capital and author of The Myth of Money newsletter. The most significant impact of the Bitcoin halving is its influence on the energy input and mining difficulty of Bitcoin, which inherently supports a higher baseline price for the cryptocurrency. This phenomenon can be closely likened to gold mining, where the principle of scarcity plays a crucial role. As more gold is extracted, the remaining reserves become increasingly scarce, making it more challenging and costly to find and extract new deposits. This requires more investments in exploration and advanced machinery for mining and processing the gold. Similarly, Bitcoin scarcity is engineered through a difficulty adjustment algorithm that halves the mining rewards roughly every 4 years. This not only reduces the rate at which new Bitcoins are introduced, but also adjusts the mining difficulty to maintain a steady rate of block creation, regardless of the total computational power on the network. This mechanism ensures that as Bitcoin becomes scarcer, the effort and cost to mine it increase, supporting its price over time. The halving mechanism is fundamental to preserving Bitcoin's integrity as a store of value. It underscores the cryptocurrency's deflationary nature, which is crucial for its long-term valuation and the security of its network. By intentionally reducing the influx of new Bitcoins, the halving events reinforce Bitcoin's status as a digital equivalent of gold, making it a potentially attractive option for future generations looking for reliable value preservation in the face of inflationary fiat currencies. Bradley Rettler, philosophy professor at the University of Wyoming. The Bitcoin halving has two purposes. The first is to attract attention, thereby drawing even more people into the network. The second is to reassure people that the rules are still in charge. Like that. Anna Lua, co-founder of Del P Digital. I think the halving is always just a great marketing event built into Bitcoin every 4 years. It obviously has an impact on its supply, but more than that, it gets everyone to pay attention to the asset and how it works. I think this halving is extra special because of two things: the ETF and the Bitcoin renaissance happening right now. The ETF is straightforward and widely covered, so I'll focus on ordinals, runes, and BRC20s. I don't think the Bitcoin ecosystem has had this much excitement around in years. It's driving a lot of attention, experimentation, and innovation to Bitcoin at a time when it's much needed. Barak Tamak, adjunct professor at Montclair State University. Bitcoin halving reduces barriers to adoption in three key ways. The concept is not only easy to understand, but we need something to contrast when learning new concepts. Comparing the halving to fiat money supply highlights the direct contrast between the two. However, these two factors alone won't drive rapid mass adoption. This is where the third point becomes crucial. It is also very easy to explain. New Bitcoiners can quickly understand and convincingly share the concept with others. What distinguishes this halving is that not only Bitcoiners, but also major financial institutions have been educating their clients about its importance. Now, moving on, institutional interest. David Zane Morris, editor of the Dark Markets newsletter. I expect a price rise after the halving, largely thanks to the new ETFs. There are a lot of new investors who are still learning the nuances of Bitcoin, and there is now a very easy way for them to buy into sentiment or narrative. The lack of friction is the truly new factor here, and I expect it to matter. James Wester, a tech analyst at Javelin Strategy. This halving is definitely coming at an interesting time as we are still figuring out the effects of the Bitcoin ETFs on demand. That makes it harder to determine how much of the halving is effectively priced in. That said, all of the issues that have gotten us here still remain: the ETFs, institutional interest, so it is reasonable to believe that demand will continue to drive the price up in the longer term. Aubrey Strobel, advisor to Trust Machines, Lolly, and PubKey. Consider this: in just a span of 3 or 4 months, we've witnessed the launch of 11 Bitcoin ETFs, with 4 of them marking the most successful debuts in history. The combined capital in these ETFs has already exceeded 50% of the assets under management in gold, a milestone achieved in a fraction of the time it took for gold to reach its current status over 20 years. Now, with only 450 new Bitcoins entering the market daily, coupled with the significant investments from major asset managers like Fidelity, BlackRock, and also Michael Saylor, the demand-supply dynamics are evident. It's simple math to anticipate the trajectory ahead. Now, what the critics say. Molly White, author of the Citation Needed newsletter. Although responsible investment advisors will often warn that past performance is no guarantee of future results, that's largely the kind of thought process that goes into predictions for the halving. Number went up last time, so number go up again. More sophisticated explainers might delve into supply and demand, suggesting that the gradual closing of the Bitcoin faucet amid roughly steady demand is what drives price higher. Either way, some people are piling into Bitcoin in belief of guaranteed double your money returns, if not better. These folks might do well to be a bit more cautious. Warren from Polymath, Bitcoin has been boring for a long time. I can't think of a single thing about Bitcoin in the past 4 years I'd actually feel excited to write about. Even stuff like Lightning slowly whimpering out should have been old news in 2020. Bennett Tomlin, head of research at Protos. The Bitcoin halving serves the important function of reducing the incentives to waste energy on Bitcoin and ensuring that many poorly run Bitcoin miners will once again be forced to confront the challenging economics of their businesses. Bitfinex, Tether critic. It's not events that dictate price in crypto. Prices in the market are determined by heads of the market, notably Tether and their co-conspirators. If you want a quote from an influential person, Giancarlo Devesini, the CFO of Tether. Wow. Illiquid markets such as Bitcoin are easy prey for manipulation. Being as primary trading pair is Tether and not the US dollar, the prices are whatever he wants them to be. As quotes from Maria Bastos, Aubrey Strobel, James Wester, David Zane Morris, and Zuko Wilcox. Okay, and that is the end of this article. Cool. Quite a long read, but hopefully well worth it. but there is a lot and lots of opinions regarding the halving, which is good, because if everybody is thinking the same, then that would be more problematic and not so bullish in my mind. But every halving event kind of has been the same for the most part. Yeah, people are bullish about it. Some people are neutral, and you have those who are bearish, as you can see. And so far, that's been good, because in the past we've had that, and the price has went up. So because we have it this time, doesn't mean the price is going to go up, but it's kind of a good sign that the price will go up again, in my opinion. But who knows? And so that is basically the end of everything that I have to say. And I hope you guys found some of that information useful or informative. Thank you all for sticking around, clicking on this video. Please remember to like, subscribe, and turn the bell notification on, and also leave a comment below. And thank you for stopping by once again. And as always, keep calm and crypto.